You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Good morning, Jim.
A big hit to the bond markets happened on Thursday. Can you explain what happened and why?
Yeah, the bond had, these are high grade, is represented by U.S. Treasuries. Long dated, was on a nice rally. The ETF we follow, TLT, rallied from 118 a few weeks ago up to 123. Now, that high was on Wednesday, and it was based upon, part of the rally was based upon that the European Central Bank under Mario Draghi would do something wonderful by way of policy, and that wonderful was a 10 basis point drop in an administered rate. So instantly traders looked at that and realized it was not the magic pill and marked interest rates up. And so that was in Europe. And then when New York opened, the bond got hit virtually all day long. So often it'll take a number of weeks to do a 4-point rally. And oftentimes, either a 4-point rally in bonds or a 4-point decline offers the opportunity for a trade. Like often the best is in. It might go a little further, in either direction, but you get what I mean. So anyways, this one just bang, was down 4.5 points on the day. But I want to emphasize that while you got the derivatives, the TLT and various others on long-dated treasuries, and you have the bond future, then you also have the trade itself on bond trading desks. The U.S. long-dated treasuries are traditionally very liquid items. So we've seen over the last year or so well-written articles from high places about that. The liquidity in the treasury market was disappearing. And this was, written by some people heading up some very large investment funds. And so it was well-founded reasoning, and they were concerned. But the way I look at it is that the liquidity that should be there isn't there because a whole lot of investors and bond trading desks are not positioning to the degree that they usually would. So, and the reason for that is that interest rates have been artificially depressed. So whether you're a skeptic or not, you just can't sit and invest to the degree that and investors and trading desks would have done, say, 10 years ago. It's artificially low interest rates, and unfortunately, fund managers have to be somewhere. And then all of a sudden, whack, you're down, as I said, 4.5 points yesterday. There's been some recovery here today. So you have now a pattern on long-dated U.S. Treasuries, which is the bellwether, from a very buoyant speculative high in January. That was with the crash in crude oil and other commodities, so that was a kind of a natural trade. And it got way overbought, and so it corrected down here. That the TLT got up to 135, and in the first hit got down to 113 in June, July, then rallied up to 127.82 in with the hit in China. Remember it? Shanghai crashed right down to what they called Black Monday on August 24th. And, of course, the bond was going with that distress. And, of course, that's another one we've reviewed, that you've got this knee-jerk move that when you have a setback in stocks, in the stock market, that the flight to quality is the long end of the bond market, whereas, for centuries, when you see a financial storm coming, the flight to quality is to the short-term items like treasury bills, which are very liquid. And the long end really isn't the flight to quality, because the flight to quality is away from risk, and the long end of the treasury market, as we've seen just this year, is very risky with the price moves. So now what does it all mean? The long-dated rates are going up. You've had an increase in junk bond yield since a very major low for interest rates in June of 2014, and the rates have been going up ever since. So what we're pointing out here is that the discussion now is that the Fed may raise their discount rate or administered rate or Fed funds rate, whatever they call it these days, soon. And this then would just fit in the pattern that when you're in wild financial conditions, whether it's now or 1929 or 1873, the senior central bank will be, maybe 4 or 5 months behind the change in market rates of interest. So I'm just going through this to point out that it really is a useless exercise to spend any time reading or writing about when or why or what the Fed may do by way of changing the administered rate, because it just doesn't matter. It'll be months behind what's actually going on in market rates of interest. So, the following the market and watching what the policymakers are saying is a lot of fun, and from time to time you get wonderful ironies, and I'm sure that when the dust is settled on this next supposed big deal about change in U.S. interest rates, it'll amount to absolutely nothing.
Are interest rates in reality on their way up anyway?
They've been heading up, yeah. At the longer maturities, both high-grade bonds with the treasuries and a junk since June of 2014. And the rise has been substantial up to, what was the low on junk bonds? It was something about 7% in 2014. And we're now up to 16%. And the high yield in the, somewhat of a mini crisis in 2012 was about 16%. And that pressures on the bond markets then were well written up. But now you got the junk yield up to that disaster high of a few years ago. Nobody's saying a word about it. It's just like, hey, we don't want to know anything about this. So somewhere it'll have an effect, because as readily traded items you see quoted all the time go up in yield. That means that, down the line you've got upward pressure on mortgage rates, and you have upward pressure on the rates that private loans are made to individuals and companies. So rising rates, not such a good thing.
Right, so expect to pay more for your mortgage or for a car loan, for example.
Oh, yeah, and then car loans. Oh, boy, that is... I don't know. They may be able to factor in that zero stuff, but people buying cars and even second-hand cars on payment, on a 5 or 6 year term is actually crazy. But
now they have 8 and 9 year loans for cars. Yeah. In other words, though, about halfway through that loan, the car's going to be worth less than what you're paying on it. Yep. Some people are just going to walk away, aren't they?
Yeah. It goes on. And yet the latest months of auto sales in the U.S. still strong.
Well, of course, because you get to pay it off over 9 years. It costs you next to nothing per month.
Yeah. Anyways, that buying cars on the Never Never is more or less equivalent to back in 2006, 2007, when everybody was buying houses in the U.S. on the Never Never. And we know what happened there with the horrendous crash. Actually, it's interesting in Canada that the Canadian real estate market and residential really didn't get the hit at all. And my guess along this period has been that the Asian bid was so strong in Canada that it prevented a decline, whereas in the United States, the Asian bid was probably there, but it got overwhelmed by troubles in their housing market. So, but that then means that, of course, the housing market in Canada, which we're really just talking about sensational prices in Toronto and in Vancouver, hitherto in Calgary, but with the oil bust, it's gone down very quickly. So it doesn't mean that these strong areas in Canada are invulnerable. Eventually, market forces take over, and anything that's way overpriced will get corrected back to a more reasonable valuation.
Well, CMHC pointed out in a report that I've been told the numbers are bogus, that 5.4% of Vancouver condos are owned by foreigners. And they said, well, that's not all that much. But Ross K. Realty Consultants have told me that what CMHC isn't telling you is that 29% of condo sales in Vancouver in the past year were to foreigners.
Yeah, it's a strong bid.
Yes, so the CMHC is totally fudging these numbers, apparently to cover their butts, because they've been lying to us for a long time.
Yeah. Well, I remember on the big boom in oil and crude oil and gold and silver in 1980, of course, house prices in Canada went up, and of course in Vancouver they really went up because the old story, you can't build north because the mountain's there, you can't build south because the U.S. is there. Then you go up the Fraser Valley and to the west is the ocean, so it's always the same story. But house prices in high-end and in the British properties, which a lot of business expense account living up there, they, from their high in 1980, fell to 1/3 in the 80s. And that's not off by 1/3, but it fell to 1/3 of the high. Now, here's the other one, is in 1980 or thereabouts in Toronto, there was a wheeler dealer who was doing bad things and charged, and he had a high-end home in Forest Hills or whatever they call it in Toronto. And the trust company seized the house, and the Financial Post wrote it up every once in a while, and by the time they got rid of that property, this was the high-end stuff, it traded for 1/3 of the high. So that is possible, and it's, you know, if it has happened, it can happen. And at the moment, the property bubble in Toronto and in Vancouver is very much inspired by very big money coming in from Asia, and you now have a fairly strong contraction going on in Asia, as represented by Shanghai, and you have very weak metal prices, which says that global expansion is not doing so good. And so ultimately, you can't sustain one hot item forever, especially when there is suggestions of contraction going on in ordinary commodities and stuff like that. And remember, I mentioned that in 1980, that high in real estate was with an exceptional high in crude oil, and gold and silver, base metals were doing well, that sort of thing. So it's going to be fascinating to watch.
We'll have more with Bob Hoye right after the break.
Unbelievable harmonies, spectacular performance, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Bird Dog and the Vintage Electric Band, Saturday, January 9th at the Alex Goulden Hall. Buy online and save at ontourtickets.com. See singing impressionist Andre Philippe Gagnon.
And I think to myself,
in Oliver, December 29th. In Kelowna, December 30th. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Bob Hoye. Bob, what's happening with gold right now?
Yeah, we've had a long, now since 2011, bear market in gold's price. Of course, mainly due to there was so much excitement and fever in the gold market right up to 2011. And then you've had a chronically firm U.S. dollar, which is often the feature of a post-bubble contraction. And the whole sector is being wrung out. Now, we have been trading at, since 2011 on, from overbought out to oversold back in. So just strictly trading. And so we're now would advise people to begin to accumulate some gold stocks on down days. The last hit to the gold market, I guess about 5-6 weeks ago, there were some commitment of traders numbers that were very concerning. Like the speculative positions were far too high. Commercials were doing whatever they're doing. So that gave the last sell on gold. And then a week and a half ago, I guess it was, the commitment of traders numbers had changed such that it was a more friendly setup. So for the sector, we would like to see the gold shares outperforming the bullion price, and that's been happening. And you also want to see silver beginning to outperform gold, but that's not happening so much. But I think we're getting an important low in here, and we wouldn't rush right in and get fully invested, but just to peck away and have a few of some liquid stocks. The juniors, of course, are never liquid at any time, or one can go through it on some ETFs, but just to get a little exposure in the stocks. I think there'd be more money made out of the stocks than owning the metal itself.
What about the rest of the equity market?
Yeah, we're looking at the crash into August and then the secondary hit down into the 1st of October, and a good rebound. We had a target using the Dow Jones on the rally. It exceeded that target line by about 100 points, which when you're looking at 17,800 index wasn't too bad. And we're looking at elevated markets here now on equities. I'd be wary of that. But within this, Jim, you have as I said, the downward pressure on the gold sector, but you've also got terrific downward pressures on base metals. And we've had, looking at it from a seasonal basis, October, and we were talking about that copper can have a seasonal low in November, and a week ago it got down to $2, has recovered a little. So we think, and the base metal miners, stocks are depressed as well. But for nimble traders, we could take a position here. We've been, for the last few years, at this time of year, we've been calling it a rotation, where beat up commodity, resource, mining sectors can be accumulated on weakness, and then for a trade, or perhaps out maybe February, maybe March, see whatever we get there. So I think there's a trade in gold stocks, and there's a trade in base metal mining stocks, but not quite yet for crude oil, because often crude oil can set a seasonal low well into December, and it's been weak, but I think the latest low was about 40, and the low with the Shanghai crash was 37. So I think crude could get a little under 40.
Bob, thanks a lot for chatting with us.
Good to be with you, Jim.
Have a great weekend.
You too.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our popular YouTube channel is Talk Digital Network. You can forward questions or comments for the show to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.